Good afternoon, everybody. Welcome back to the Opportunistic Trader. We're now joined by Adam Collins of Movement Capital. Adam's been joining us regularly to discuss the latest CoT report and market seasonality. It's always interesting to speak with him at the beginning of the month as we take a look at seasonality, what's coming up. Adam runs a number of different really informative websites, freecotdata.com, simplestockmodels.com, commodityseasonality.com, and his website, movementcapital.com. How's it going today, Adam?
It is going pretty good. I am happy to be here. So let's get started. Right off the bat, this is not investment advice, so don't treat it as such. And for any new listeners up there, the main thing I talk about is CoT data, and this covers how people are positioned in the futures markets. And I think it's important to not just look at current positioning, but give it context. Is it extreme or not relative to the past? And if you're new to the CoT report, this is what it looks like. You got different trader categories, and for each given category, you got longs and shorts. When you net those together, you sort of get the net positioning, but you need to know if that current net positioning is high or low relative to the past. And so what I do is I make a 5-year percentile. If it's 100%, it means that category is more net long than they've ever been over 5 years. If it's 0%, it means they haven't basically been that pessimistic over the past 5 years. And this is actually the main page I look at. This aggregates together all these positioning percentiles based on the trader category, like, speculators or producers, and then also the contract type, like commodities or financial futures. So this is sort of a snapshot of spec positioning in commodity futures. Stuff on the left, people are long. Stuff on the right, people are not. So to no surprise, we've got natural gas, which is a very consensus, long trade, closely followed by oats, palladium, and palladium sort of strange in that it's only precious metal, where traders are actually quite bullish on it. And then honestly, not much else on the long side, crowded wise, but on the short side, we've got mainstays of 2018, which are silver and gold. And I should clarify that when you're on the right-hand side of the chart, it doesn't exactly mean that trader positioning is like super net short, because remember, it's a percentile. So let's take a 5-year period in which traders have actually never been net short. Let's say they've always been net long, right? Well, what that means is that a 5-year percentile can be 0% if that net long position is just as low, as it's ever been over the past 5 years. And that's sort of the case in gold and silver, in that trader positioning, you can't characterize it as like this mega net short position. It's really not. It's just that traders aren't that bullish relative to, since 2013. We're nowhere near sort of the pessimistic extremes in decades prior. And so zooming on to other contracts. So these are financial futures. And the main takeaway message has not changed, which is long USD positioning is very stretched. These people are primed for disappointment. Today probably, hasn't helped that. And when you want to dial into the currencies that traders are actually most net short against the USD, you're looking at yen, franc, Kiwi dollar, Aussie dollar. Euro sort of stands out as, actually euro and peso, as two currencies that sort of, buck the trend of traders actually pretty net long, both those. And so that's, it sort of skews everything because, the US dollar index is roughly half euro, and traders are actually quite long the euro against the dollar. But there are a way larger number of currencies where spec positioning is definitely leaning net short. Like I said, led by the yen and the franc. And then we can look at producer and user positioning in commodity futures. So this is the main category of traders on the other side of speculators. Hence, while positioning is typically a mirror of spec positioning. So on the left-hand side, you can see contracts where basically producers and users are optimistic. And that can be one of two things. You can either have, producers who see current prices and say, hey, I don't want to short a lot of, future exposure and lock in prices for future production. And they would only do that if they think prices are low, right? Or you can have users come in and say, hey, I want to fix prices for a bunch of my future inventory by locking in, current prices and buying futures here. So producers hedge by shorting, users hedge by buying. So from the left-hand side, you've got sort of like minimal producer hedging and then probably more so user hedging. Then over on the right-hand side, you've got contracts where producers and users are sort of leaning more net short, which implies that sort of producers are swamping it and dominating, saying, hey, we really want to hedge right here and lock in prices for a bunch of future production. And the contracts that dominate there, mainly oats, a little bit of palladium too, which is strange. And then, yeah, we can dive into some individual charts. So like, let's look at nat gas. So that's the, most crowded long trade in commodity futures. Let's see here. Nat gas. All right. So obviously spike happened. Everybody jumped on the trade. Like I talked about last week, given the magnitude of the move, I probably would have expected more extreme long positioning in that gas. I mean, it was such a violent move, but we're still below net long spec positioning levels from the much milder moves like in late December 2016. And so if somebody says, oh, positioning is way too stretched in that gas here, yeah, it's high, but it's not some like multi-decade extreme or anything like that. So that's nat gas. We can look at some of the, I'll look at WTI. So let's see, WTI, it's exactly what you'd expect as traders have sort of, puked out their long exposure, but it's not to say that they're not short in any capacity. There's still a big net long positioning in WTI. It's just not really super, super extreme. And I think in dollars, it's like net long 15, 20 billion, which is off the highs of, 50, 60 billion. And so there's still, if WTI were to continue to go down, there's still long exposure there, but it's such a rapid move in positioning. You tend to get like, once you see a reduction from like, 60 billion to 20 billion, that doesn't tend to stick for a long amount of time. Like this is anecdotal, but when you get these big dollar drawdowns in spec positioning, there's typically some sort of like retracement to it. We can look at gold. So gold is more of the same over the last bit. Gold's honestly chopped around. Specs are still not super optimistic on it, but they're not as pessimistic as they were in early October when they actually were net short. Same case in silver. And then like I talked about palladium just stands out. Palladium, it's risen a lot year to date. And here's an interesting setup is, so palladium in January, positioning was very stretched on the long side. Like, so with a 5-year percentile of 97%, the white line basically says, hey, traders are more net long this thing they've ever been over 5 years. And that ended up being a pretty good tell of future price performance. But what I'm getting at is whenever you have something that makes a high and traders are super long, right? Then it corrects and then it sort of is higher than that high, but spec positioning is not as net long. That sort of says to me, okay, price has risen above previous highs, but there's not as much participation. And it says to me, if palladium were to continue to rise, that's going to suck in the people who weren't quick to rejoin the rally. Sort of a rare type setup. And then let's look at some other stuff. We got, I don't know, we looked at gold, gator cattle, cotton, corn. Look at some other sectors too. So like I talked about, when you're looking at dollar positioning, the most crowded short against USD is the yen. And so here's sort of a zoom in of that positioning. I would highly suggest anybody, like if they've got some sort of trade thesis about the yen or Japanese stocks like JGBs, there's a company called Horseman Capital that puts out free PDFs. They do really good Japanese research. I was running through it this morning. So either way, yeah, yen positioning is very short. And then one sort of anecdote from that research I read this morning is that it's sort of crazy how, a lot of people look at these international government bond yields of like, JGBs yield nothing, right? And say, why would you ever own that? Well, if you're a U.S. investor, you can get long JGBs, and when you hedge out the currency risk, they actually provide a higher yield than U.S. Treasuries, which is, I don't know, not what a lot of people would expect. But vice versa, just as that sort of like a yield boost for like, U.S.-based investors, it's a yield headwind to yen investors. And as we all know, the Japanese are sort of big international global investors, and when international assets become super low yielding, when they sort of rehedge it back in yen, that sort of triggers, maybe I won't say triggers, that's sort of more of an incentive for capital to flow back to Japan when just like, foreign investments aren't yielding as much net. Anyways, that was a tangent from positioning, but yen is, crowded short. Nothing to write home about Canadian dollar. Positioning's mixed. British pound, same thing. Aussie dollar, definitely leaning short, not extremely so. And then we've got Kiwi dollar, same story as Aussie dollar. Positioning is no longer really extreme. We got Swiss franc, USD. We can look at some equity index futures. So we've Then we've got, hey, Mike, I think your mic's on. Yep. Anyways, so here's S&P positioning. So, traders are still net long. It's come back. So in January, we hit highs, positioning wise of like net long 100 billion. Now it's around net long 50 billion. Then we've got VIX, and this is the more interesting thing to me when it comes to equity positioning. Traders are net long VIX. Traders are net long VIX, and this entire cycle that has been a huge tell to fade volatility spikes. Now, obviously, the cycle inevitably turns. The people who sort of were quick to short vol will regret that, but I think it sort of bears out in April of this year when traders got super net long VIX futures. That was a big fade, and traders aren't as net long right now, but I think it's worthwhile to point out that consensus, spec positioning on VIX is leaning more bullish than bearish. And then we've got actually let me merge over to seasonality. So like Mike talked about, first of the month is always a good time to revisit seasonality because you can sort of establish your seasonal trends in advance. And this is the main chart I use on my seasonality website. It's just taking a 20-year average monthly performance number for a bunch of different contracts, right? Let's go to December. All right, December, what has worked, what has not? So historically, December has been a very kind month for palladium, cotton, sugar, corn, S&P. And then honestly, December hasn't had a lot of negative seasonality except for in nat gas, heating oil, and OJ specifically. So I guess takeaway for December seasonality is palladium and cotton, big standout months, is they've had sort of positive seasonality in December. And we can look at some individual seasonality charts. In fact, let's look at the palladium chart. So here's palladium. And palladium is sort of similar to all these other metals in that their seasonality, like check this out. In platinum, the main seasonal trend for platinum is like Q1 strength, January, February. It's not just platinum, it's silver too, it's also gold, and also palladium too. Where palladium's different is over the past, 10, 20 years, palladium has had sort of this, this sort of standout Q4 strength that's really not present in a lot of other precious metals. And to palladium's benefit right now, its curve is significantly flatter than gold or silver. And what that means in plain English is with like a flat term structure, you're not having to bleed a roll yield as you roll your long positions. And that is the case in, gold, silver, and platinum. And then we can dive into some other seasonality charts. So 30-year bond, today we're talking about yields. All right, so what are the seasonal trends for bonds? Honestly, not much other than summer strength. So that sort of goes hand in hand with late summer's a period when equities and risk assets tend to fall, and then sort of risk off assets like the 30-year bond and then the yen and gold tend to do well. So not really any December seasonality to read into for the 30-year. What about euro? Euro actually does stand out, as December has historically been the most positive month over the past 20 years for euro against the dollar. And not really anything to write home about in the yen. And then as everybody knows, S&P seasonality is sort of like the quote unquote best 6 months of the year in the, late Q4 to end of Q1, Q2 period. And we're definitely in those best 6 months of the year right now. And then we can turn to some of the S&P stuff. So this is another site, and the main goal is just to break down just different aspects of the S&P so you can look at technicals, sentiment, rates, macro. So let's look at technicals. Technicals, on average, pretty strong, getting weaker, but still sort of like, and when I say technicals, this is sort of more longer term stuff. It's certainly not intraday. So momentum is still positive, as defined as like 12-month momentum, but we're definitely below, the 200-day. And then seasonality is a strength. FOMC drift is like the tendency of the S&P to rise more often than not, and the 20 days leading up to an FOMC meeting. We're definitely, in that period right now. Probably the most interesting technical thing is, sorry about that. The most interesting technical thing is that margin debt is now contracting year over year. And this graph, it just like super barely shows it just because it just got updated. But yeah, so when people talk about margin debt, you typically get spooked, right? It's a big number. It's a big, scary debt number, right? I don't really look at it that way. I just look at like a year over year change. And so what's historically been interesting is that the S&P has historically struggled when margin debt has contracted year over year. And then another thing that's worth pointing out is that before, the past two recessions, margin debt really accelerated like late into the credit cycle. And we really haven't seen that, this cycle. And then we can look at some sentiment stuff too. So as you'd expect, sentiment has gotten more bearish, be it the AAI survey, be it, the name exposure index. All these survey metrics are indicating, more bearishness. Put call ratios did come back a bit last week, and so they're definitely not, indicating a bunch of fear in options markets. And we can turn to rates too. So this is the U.S. 10-year minus 2-year yield curve, and historically, what's been bad for the S&P is not so much, flattening or inversion. Everybody talks about that, but it's more so really quick steepening. And if you ask yourself, like, well, that's sort of counterintuitive. You think about it in terms of when does the U.S. yield curve typically quickly steepen? Typically in a recession of when the Fed comes in and just massively ratchets down short-term rates. So that's stuff worth keeping an eye on. High yield spreads are, I know they came back a little bit yesterday, but they're still above their 12-month moving average. So high yield spreads are sort of, they're not blowing out. That's the wrong word to use, but they're definitely expanding, not contracting like they were for most of the past 2 years. TED spread, it's risen a little bit. This is just the difference between, a risky rate like LIBOR and a risk-free rate like 3-month treasuries. And so TED spread is rising a little bit, but we're nowhere near either earlier levels or especially 2008 levels. Finally, let's look at macro stuff. So U.S. macro indicators are quite positive still. Industrial production, positive year over year. It's a healthy, business sign. Retail sales, positive year over year. That's sort of a sign of, the health of the average U.S. consumer. We've got unemployment rate, which I know is quite low at 3.7, but it's still trending lower. And so the thing I would get scared of is if the unemployment rate started rising above, its moving average, which would indicate like a, deteriorating labor market in the U.S. ISM PMI, it's come back a bit, it's still above 50, strong. Housing prices, this is the one area, and prices is not really the best metric to show this, but we've all read the articles about, new home sales declining, mortgage rates going up, making housing less affordable, right? And I think I remember reading housing is roughly 15% of U.S. GDP. And so if we have a substantially weaker housing market, that's definitely not a good sign. So I would say the one sort of not hot macro thing is definitely housing. So overall, in summary, in positioning, everybody's long nat gas, and then crowded long positioning is also sort of present in oats and palladium, but it's not super extreme. On the short side, traders definitely still pessimistic on gold and silver. Probably the main thing with positioning, it's crowded short USD trade, particularly against the yen and the Swiss franc against the dollar. And then for seasonality, main takeaways is that December has historically been a positive month for palladium and cotton, not so much OJ. And then for S&P takeaways, I would say, technicals mixed, sentiment definitely more pessimistic. Nothing really to worry on the rates point of view, except for high yield spreads. I would keep an eye if they keep on blowing out. And then on the macro picture, I would definitely keep an eye on housing too. So overall, it's a bit of a crash course into positioning, seasonality, and S&P stuff.
Great. A lot of great information there. Hey, quick question for you. Do you happen to have seasonality on possibly ETFs? So for instance, the home builders ETF or something like that. Do you have seasonality on maybe when they do better, or retail sector when they do better?
No, I don't. And it's a thing of I don't know. It's so S&P seasonality is going to play a big role into it. But I don't have any insight into the nuance of sector seasonality. I might run the numbers later on that.
Gotcha. Yeah, I was just wondering. While you were talking, we took a leg lower in S&P. We fully retraced any gap from Friday. We're actually trading right now 2740, down 50 points in the S&P. It's been a big bond day, yield day. Bonds up one full point, basically 1.5 points here. 10 years up 12. So it was really interesting. So seasonality for December, as you pointed out, platinum, cotton, sugar,
no, palladium.
Oh, I'm sorry, palladium. Yeah. There you go. And then euro, typically so December is typically a weak month for the dollar.
Correct. Yeah. And so, that sort of lines up with the crowded long USD positioning. But I will say this, it's like, for seasonality, I don't sort of treat it as like this all else equal thing of I personally assign more weight to like commodity seasonality as opposed to especially like FX, because to me, there's just like less of a fundamental reason for foreign currencies to exhibit like continuous seasonality over multiple years.
Well, it could
So
be a corporate sort of thing as well. Like people are repatriating or people are converting. There could be something to that as well.
yeah, it could be.
But no, that makes a good point. And OJ, I think if you could correct me, but I think in November OJ was a great month typically, and then it's looking like November is November December is a bad month, so a bit of a back there.
Yeah,
All
sure.
right, but hey, Adam, I really appreciate a lot of great information there. Some great seasonality points there. So you can check out a lot of Adam's stuff. He's got a number of great websites: free CoT data, movementcapital.com, simplestockmodels.com, and commodityseasonality.com. We really appreciate the data, and we'll talk with you next week.
Yeah, for sure. Thanks. See ya.